meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
Doing great. Thanks so much for having me as always.
Absolutely. I love our conversations. I want to have more of a almost theoretical discussion with you because we are seeing true pain in the markets. We are seeing true pain in the economy. I have personally studied the consumer for greater than 3 decades, and I've been an investor for better part of 2.5 decades. And everybody's a consumer, but not everybody is an investor. And I think the Fed is unfortunately in a box where they have to pick a winner and loser. And at the end of the day, I think the Fed will pick the consumer because they have to. And that's what Paul Volcker did in the 80s. And unfortunately, that means, if you're in the market, the pain's not over. What do you think of all that thinking? Do you think there's a way they could thread the needle and everybody's happy?
No.
Yeah.
You and I have both been in this camp, right? We both have been in this camp. We've had a little bit of a difference in approach as to how we think we get to recession, but we both have been in the recession camp since we started conversation 3-4 months ago, whenever it was. And this is well before it was kind of conventional wisdom in the market. Mm-hmm. But no, I do not think that they can thread the needle and make it through to raising rates to curb off inflation that's been the highest it's been since the 1980s. And at the same time, do it without enough demand destruction to cause us to move in a negative GDP direction, to see the economy come in. They have to destroy demand. That's how you control inflation. When you raise rates, this is oversimplifying. When you raise rates, you're essentially making debt for everybody more expensive. Mortgages get more expensive, consumer debt gets more expensive, credit cards. It also affects, and this is where people see it through the consumer lens. They see, okay, I understand how it affects me, but think about how it affects corporations as well. If corporations can go out and say, hey, I can build this product and get a 10% profit margin, but I need to build out a factory in order to do it. And last year I can get a loan at 3%. And therefore my spread there is 7%. And this year I can get it at 5.5%. And all of a sudden my spread is 4.5%. And my margin of safety is not there anymore. So therefore, I'm not going to build out that factory, which is going to utilize the lumber, the steel, and the labor supply to spur on this economy. And instead, I'm going to keep that money or I'm going to keep that and not go out and do that. And that's where you start to see the rollover effect on the economy by the Fed raising rates.
Yeah, a hard landing has always been the option. I think the longer that the thing about Wednesday for me, we talked about in the first episode, or maybe it was the second, is the longer that they try to clearly communicate to Wall Street what is coming and give Wall Street, or in this case, the market, a chance to prepare.
Yep.
The longer this thing, it's like your mom ripping off a Band-Aid, right?
Yep.
I don't know about yours, but my mom always did it. Even though I knew it was coming, it always worked, right? She did the whole 3, 2, 1 thing, and she always ripped it off at 2. Powell, call my mom. She'll tell you how to do it. Just because, again, you will have short-term pain. The market will capitulate. We'll get a VIX to 40. It will be ugly for a couple of days. And then I promise you, it'll bounce.
Yeah, it has to. The rates have to get there, right? Right. They have to move them up because this inflation has proven to be so darn persistent. And so, I don't know when it comes. No one knows when that capitulation point comes. If they did what you're suggesting, I think capitulation comes right soon thereafter, and the market drops at a 15% rate, whatever it is, and you see the bottom there. But capitulation's still going to come at some point. We just don't know how that's going to play.
Why wait? Why have 20 months of this? Just
no, it is. And why not try to control inflation? To your point, we could also control inflation more quickly if we did that.
Yeah.
So and how from a portfolio management standpoint, what we do is, so our most aggressive, if you will, it's not aggressive, but our most aggressive portfolio is called Wealth Builder. Wealth Builder has the ability to go 90% stocks. Right now we're at about 52. And we've been in that camp. So we've been in this defensive camp, and people have kind of questioned, hey, what are you guys doing, this and that? What are you looking at? We launched 3 conservative ETFs in the heat of the bull market last spring. It's like it's not to say that we had some crystal ball and we're smarter than everybody else, but it's just to say that things revert back to the mean over time.
Exactly. Yeah.
And the economy is going to revert back to the mean because it got overheated, and the market's going to revert back to the mean because the Fed is standing on the brakes at this point. And that is what it is. That's how economic cycles work.
Yeah, I think this is an Elon Musk quote. The last 2 years we rained money down on fools, and now we've got to take the umbrella away.
Yeah.
And
Yeah.
again, what I think it needs to happen, I don't think it will. I'm just going to keep putting it out there and just hope karma kicks in. He does 100 basis points or 75. I would love a round number of 100. Kick the market in the nuts. And what happens is Wall Street's caught flat-footed, kind of like Friday. You have a couple of very, very ugly days. You find out who's swimming naked because there's some idiot on leverage, probably several idiots on leverage. They get smoked. Kind of market works it out. You get leverage wrung out of the system because there's the amount of leverage in the system, let alone crypto still. Are you guys freaking nuts? What the hell are you doing?
You cannot leverage an asset class that is, so the standard deviation on Bitcoin is 80. The standard deviation on the S&P 500 is 16. Like that's how much more, it's more than 5 times the amount of volatility. If you're putting leverage on a product that's 5 times more volatile than the S&P 500, that's scary. It's scary. It's just, you know what it is? It's not anyone's fault. The problem is this stuff became so it's someone's fault, right? But
come on now. That's somebody's fault. Come on.
But let me hold the hand of some of these consumers that they were brought into the market in 2021 when things perpetuated up. They were influenced by people that either had a motive or a lack of understanding, and it's their fault that they didn't do the back work of their own research to get them there. But there are a lot of people at fault here that aren't taking blame, and who knows? Their thing is like, this will bounce and this is short term, and I don't know. I think you and I are both on the same side of that. It's like there's more pain to come here.
Yeah, there's a lot more pain to come. Again, leverage. I'll say it differently, right? If you have an investment thesis that's 5 times more volatile than the S&P 500 and you add leverage, if you call yourself a speculator, I'm cool with that. Because the big thing for me is, are you an investor, a trader, or a speculator? As long as you call yourself the right thing, I don't care.
Yep.
But if you have leverage on an asset that's 5 deviations more volatile and you call yourself an investor, I want to slap your hand or something worse, because that is stupid. That is dangerous and dumb.
Yeah. We talked about books one day on your show, and I talked about one of the books that I like the best. And this is one that's wildly heralded in the market because it's so good. Morgan Housel wrote The Psychology of Money. And one of the things he said that's the scariest psychological thing that plays out in the market is when you start playing a game in the market that's not the game that you intended to start out doing. So if you started out coming in saying, hey, I'm saving for retirement, I want to invest for retirement, and all of a sudden you get caught up with thinking, oh man, look at those short-term profits I see on this stuff that's happening overnight. My friends are making millions, etc. And all of a sudden you start playing their game, and they might not be playing the same game. They might be traders. They might know that they are only going to hold it for 2 days and they're going to sell out of it. But you get forced into that longer term trade. You catch all the downtrend because that's not what you're in it for.
Yeah.
And it's a tough game in that direction.
Yeah. Again, folks, what I want to tell you is coming. We're still in this. We're going to be talking to Taylor every Monday. Life Goal Investments, a lot of stuff. Next week's conversation is going to be interesting because we're going to find out if Powell has a backbone or if he's just going to stand there and say, all right, we're telling the market 50, 50, and 50. So
that's coming, by the way. That second part is coming.
That's coming. Exactly. Where can people find you?
Yeah, find us on Instagram at Life Goal Investments. We're putting out daily content there on just broad economic information.
And I love the fact that you are 52% conservative in a ETF that you could go to 90. I suspect sometime this year you're going to get closer to 90% as the market bottoms out.
That's exactly, and I'll say this as our parting comment. In the game of portfolio management, in the game of asset allocation at the individual level, et cetera, the money is not made in between the extremes. The money is made in the extremes. Did you chase at the top, and did you get really conservative at the bottom, or did you get aggressive at the bottom? And that's when the real deviation happens at wide margins.
Awesome. Thanks, Taylor.
Good to see you, Michael.